The stock market finished out 2018 with volatility and has continued to have ups and downs in the new year. The trade dispute with China and now the partial government shutdown have added to the uncertainty. Carolee McGrath sat down with Michael Matty, president of Germain Investments in Springfield, to find out more.
Well, what we've seen after a surprisingly low time of volatility in the prior few years, a year ago we would have been talking about the fact that we were at historically low volatility. We've now kind of gone back to more of a normal market environment where there's been what in absolute numbers seem like very large up and downs on the market. But I say absolute numbers because the market's so high now that, I started in the business 30 some odd years ago. A 500-point day was front page of the newspapers back then. 100 points, in fact, was front page of the newspapers. Today, in percentage terms, with the market being 10 times higher, it's barely a headline anymore.
So talk a little bit about, so that we hit a historic high back in October, 26,800 or so, and back it up to like last January, a historic high was 26,000. So the gains are impressive. Obviously, there's been volatility, which followed.
Yeah, again, we had a very good run in the market actually over the past couple of years. Going back even farther than that to 2008, you're 7,000 on the Dow to 26,000 on the Dow. It's, a pretty impressive run at that point. Again, I would expect some sort of volatility to come out of the market at some point, and we had an unusually quiet period. But now with the, again, it's been a long run in the market, very low volatility, and now we're returning back to more of a norm because, in large part, that economic expansion still in, has just been in existence now for an awful long time. The shutdown, obviously, is sort of the newest news. The trade war with China. There's obviously a number of headline risks out there that just have gotten people a little bit more focused on news as opposed to the prior year when the big focus was the tax cut, the tax cut, right. The tax cut, because there was a huge tax cut for businesses that really was a huge benefit to the bottom line.
So talk a little bit about the trade dispute with China and how that has come into play.
Obviously, China, a very large trading partner of ours, second largest economy in the world at this point. And so obviously anything that's going to interrupt our exports to China, imports back and forth between us and China is going to start to have a big impact on a multinational company in particular, of which most large companies are multinational at this point and so have a fair amount of production and or sales to China.
Obviously any sort of a deal in the near future would change things as well, make the market happy.
Yeah, obviously the China stuff coming off the headlines at this point would be a very positive thing, I think, for the market because the market dislikes uncertainty. And it's very hard to sit down and try and make forecasts, economic forecasts for a company in terms of what their sales and earnings are going to be for the next year or two when you're not sure how one of their absolute biggest markets is going to fare.
Right. And let's talk a little bit. You mentioned the shutdown, longest shutdown, right? So now, how is this going to affect the market, as we look, to the coming days and weeks?
Again, it's one of those headline risks that with the shutdown, nobody knows how long it's going to go on. Nobody knows what the ultimate economic impact out of it is going to be. It's not that long that these folks haven't had paychecks for so far, but if it goes on,
it feels long for them, right?
Absolutely.
Yeah.
There may be some boost at the end of it. You get some back pay, you get an economic boost at that point, but nobody knows when or if any of these things are coming. It may be a very long time, and who knows what kind of a deal is cut in order to bring about an end to this.
Okay, and let's talk a little bit about unemployment. Unemployment has remained low, which obviously is a good sign for the economy.
Yeah, this is effectively the greatest job market not only of my working career, practically of my lifetime. So unemployment is fantastic at this point in terms of trying to if people are out looking for jobs,
right.
It's tougher for employers to try and hire people at this point. You hear about this ghosting phenomena where people go out, interview, accept
yes.
2 or 3 jobs, and don't show up for 1 or 2 of them.
Right, and so people are watching the interest rates as well. Those have been coming up incrementally.
Yeah, so interest rates have crept back up a little bit. You're actually starting to get, unlike a year or two ago, maybe some CDs that are starting to look a little bit attractive to people. bonds. Our bond guru in-house is always talking about the fact that, somebody putting together a bond portfolio right now can actually start to see some decent yield coming out of a bond portfolio unlike prior years. So if folks are nervous about the stock market, moving some money over into some fixed income, some bonds is possibly not a bad approach at this point.
Okay, so as we look at 2019, that's one bit of advice for people. What is the other financial sort of fitness advice that you have for people as we start off the new year?
Well, from a personal standpoint, it always comes down to, as we talk about things like paying down credit card debt. That's, for most people, we're sitting there talking about attractive fixed income yields that are in the low to mid single digits at this point, but you have credit cards that you're paying 15, 18, 20% on. That's crazy in this environment. Your best return is to pay down some of those credit cards if you absolutely can. Things like perhaps reallocating your portfolio. If this volatility is scaring you and you can afford to move a little bit of money out of the stock market and into the fixed income market, maybe it's the time to, we're still fairly close to those highs. It might not be a bad time to try and take some money and get a little bit of volatility off the table.
But if you're a younger investor, do you ever recommend doing that? Or do you just say, ride it out because there's going to be ups and downs, right?
If you're on the younger end of the spectrum, I've got a daughter in her mid-20s, 100% of her retirement money should stay in stocks. She, had recently bought a house, but prior to that had some money she had in a pot sitting there waiting to buy a house. That's totally out of stocks. But if you've got long-term money and you've got decades left in front of you, which, by the way, even at 50, in mid-50s, I've got decades worth of life in front of me, hopefully, at this point. And given that that's the case, most of my money should still be in stocks, but I can handle the volatility, so it's okay by me.
Okay, but you can go to your financial advisor and say, yeah, I'm a little bit nervous. I'd like to move it into something a little bit safer.
Yeah, especially if you're getting a little bit closer to retirement, you've got some money that you're going to be needing for college tuition, some estate planning type purposes, et cetera. It's not a bad time to say, let me revisit my asset allocation and see whether or not this is the right mix for me.
Okay, and emergency savings, because we're talking about those federal workers who didn't receive their paycheck, and the next one comes next week. When you talk about that, a lot of times people are in crunch mode. They might not have 6 months worth of savings. They've got little kids. They're living check to check. How do you advise people to slowly build that up?
It doesn't matter whether you're a federal employee, whether you're working for a private industry, and right now, unemployment's very low and the economy's doing great. We don't know this time of year from now what might be happening. This is probably a good time to try and get some of that emergency money put aside. And when I say emergency money, it's fairly readily accessible cash that's not in the stock market. It's not going to be subject to volatility of the stock market. It's sitting there in something safe. You want to preserve the buying power of that money and have quick access to it in case something like this were to happen to you.
Okay, and when you're thinking about retirement, savings, and paying down the credit card debt, do you give money to yourself first? Do you pay yourself first?
Yeah, one of the greatest things you can do is just have money automatically taken out of your paycheck. If you don't see it, it's a lot harder to spend it. So whether it's a direct 401k deduction, for example, from your paycheck, whether or not you have your deposits broken up so some of it's going right off into a separate account from your checking account so you're not tempted to spend it out of the checking account. Whatever psychological trick it is that works for you is really the way to do it. Some people are very disciplined about getting paid and moving some of that money over to another account. Other people say, I need to just not be able to see it. So whatever it is works for you.